Welcome, and thank you for joining our webinar today. We hope you, your families, and colleagues are staying safe and healthy and enjoying the nice weather. I'm Andrea Smith, Senior Business Development Manager from RPS, and we'll just give everyone a couple minutes to get signed in and settled. Okay, let's get started. It's now been 15 months since the first closures as a result of the pandemic. A lot has changed. On the side of the pandemic, we've seen lots of lockdowns, vaccines rolled out with first shots that have been had by 65% of Canadians. Second shots are coming and expected to occur in short order. And the number of cases and deaths have come down significantly. And after a long time, reopening and a much more normal seems real. In terms of the housing market, we started out with big concerns last March when everything stopped. But then the market picked up steam a few months later, and 2021 has been a very, very busy year. In other words, values, volume, and vertigo, the title of our presentation. So what's in store for the housing market going forward? This presentation will cover where we have been recently and are now, and what we can expect going forward, including through to 2023 and beyond. I will caveat that these times continue to be unusual, so these are educated forecasts. We'll get into the logistics in the presentation, but first let me take a minute to tell you about the RPS Moody's Analytics forecast. The two companies partnered in 2014 to create a macroeconomic forecast model, the first commercial offering of its kind in Canada. RPS, bringing its expertise in valuations and our leading most comprehensive house price index in the Canadian market. And Moody's Analytics brings extensive international experience as a leader in regional economic forecasting. The forecasts cover multiple scenarios and geographies from the neighborhood and city level to provincial and national. They are used by financial institutions to support their ability to assess, analyze, and understand risks and opportunities within their portfolio. Just a couple of housekeeping items before we dive in. We will be recording this session and we'll share the recording and presentation deck following the session. We will be placing everyone on mute during the webinar, but if you have any questions, please feel free to ask using the chat feature. And if you're having technical difficulties, let us know in the chat tool and we have our staff monitoring to help you out. The presentation today will be approximately 40 minutes and we've allowed 5 additional minutes for a Q&A period to ensure that everyone has a chance to ask questions and hear a little more from our panel. Now the reason we're here. I won't waste too much time introducing our speakers other than to say they're the brains behind our HPI and the forecasts. The speakers in order that they will be presenting today are from Moody Analytics, Brendan Lacerda, Associate Director and Senior Economist. From RPS, Brian Toja, Head of Data Analytics. And from Moody's, Abhilasha Singh, Economist, Housing Economics. Brendan, I leave it to you to take it from here.
Andrea, thank you so much for that kind introduction. I think maybe your comment was a little modest. In my view, it's been a wild year for the housing market. Right now, prices are up 15% year over year. A couple major metros north of 20% appreciation year over year, and a couple of smaller, cottage towns, 30–40% gains. I think it's enough if you look at the numbers that the room seems to start spinning. You have this dizzying effect. So, I thought it only appropriate today that we try to ground ourselves, and in these volatile times, try to look through that volatility and assess what are the fundamentals and what direction is the housing market headed. And I think the reason I want to advocate a return to the fundamentals is because, for all intents and purposes, the economy is on its way to its return to normal. So, Andrea, if you jump ahead to the next slide, actually maybe 2 slides. With obviously the biggest development and the best news at the moment is the improved pace of vaccinations. If you want to jump ahead to the first chart that shows the pace of progress in Canada, we've gone through 3 waves of infections, but the current levels lowest they've been since September, and that's really all because of this improved vaccine rollout. So if we start to think about the return to normal, well, when does that really begin? And I think the point would be when we've achieved herd immunity with regard to vaccines. The WHO, a lot of medical experts, no one really knows what that threshold is. I pulled together some data that we know for polio, it's about 80%. For relatively more infectious diseases like measles and smallpox, that level is about 95%. So, judging by the current pace of vaccinations, anticipating a little bit of a slowdown ahead, it's our view that the number of cases will effectively abate by mid to late July. But I think a lot of the issue with regards to Canada is that while most people have gotten their first dose, vast majority of people are still waiting on that second dose. So in terms of truly hitting that 2 doses herd immunity mark, that's likely to come about in September or October, which is crucial because what we've seen in the past is infections pick up once the weather gets colder. So a lot of positive a lot of positive developments on this front. So in terms of if we take away the virus, what are those primary factors that are driving the outlook? So we began the call by talking about values, volumes, and vertigo. I'd like to introduce sort of another trio, which is driving the forecast, which is shots, savings, and stimulus. So if we jump ahead to the next slide, sort of the fundamental basics of understanding the outlook is the shots, the vaccinations allow the recovery to proceed. You sort of create the conditions on the ground to actually have the economy keep growing. Because as we've seen in the past, when infections rise up, the recovery stalls. So with herd immunity in place, the recovery just proceeds. The next element is savings. What you can see in this chart is the orange line, which is with all the fiscal stimulus that has gone out from the government, all the unemployment benefits, wage subsidies, savings is quite elevated. Consumers have gotten a lot more money than they've spent. The key element of this elevated savings rate, though, is that it facilitates the release of pent-up demand. So if we look at sort of the state of consumer spending right now, a lot of money going into durables, a lot of those service industries that were hit hard by the pandemic are still depressed. However, going ahead, what we anticipate is that we'll have a rebalancing away from goods spending and back into services. And what allows that to happen is that people have cash on hand. They have this savings. Also, with the government's fiscal year 21 budget, there is more stimulus on the way. And what that means is that it'll give some extra acceleration to the recovery. And, putting this all together, and thinking back to, a year ago, it's always important to look back and see, how has the forecast evolved? And we can see, we pre-pandemic projection, sort of modest pace of growth, but, going back to like the darkest days of, June 2020, the outlook was pretty grim. We didn't expect much of a strong rebound. We didn't expect vaccinations to come until later in 2021, which is why, we didn't really anticipate things taking off till later. But then, we got a lot of fiscal stimulus. We got initially strong recovery, but, the persistence of the virus, still this sort of suboptimal growth. However, sort of in the final, the most recent iteration of the forecast, what you can see is that, when we add in the additional stimulus that the government's bringing to the table and the vaccines, right now we are projecting a GDP path that exceeds our pre-pandemic projections, which is, a really striking thing to say. And I think it, really speaks to the speed of the recovery. If we jump to the next slide. So, with this really rapid recovery, and just to put a finer point on that, if we look back at the previous recession, when unemployment peaked in 2010, it wasn't until 6 years later that we got back to pre-recession unemployment rates. With the current recession and the current crisis, we're going to get back to our pre-pandemic unemployment rate in about 2.5, 3 years. So think about just the speed of this recovery is quite astounding. Of course, what's the cost associated with that? And standard theory would tell you inflation. There's been a lot of stimulus. We have very low interest rates, and a supply-constrained economy in some regards in certain industries. And so what you see is, we're going to have this big bulge, this above target pace of inflation over the next year, maybe a little longer. So I think, well, the rise in inflation has spooked a lot of folks. I think it's important to keep in mind that, how close are, prices right now to where we were predicting pre-pandemic. So if we think, the Bank of Canada has a 2% target for inflation. If we go back to, 2018 Q1 and say, where would prices be if they just continue to grow at 2%? You can see in the dark blue line how much we've deviated from that 2% price range. So, prices collapsed in the early days of the pandemic, and they're revving back up. So, a lot of what explains this recent burst of inflation is just prices getting back to where they probably would have been without the pandemic. Airlines raising their prices, restaurants raising their prices, retailers raising their prices. However, to a large degree, there's only a certain limit to the degree they can lift their prices. And what we're anticipating is that, this deviation will actually disappear and that prices and inflation will cool down come 2022, 2023. So we're not anticipating too much of a risk of the economy overheating right now. It is on our minds, but, given the amount of slack in the economy, particularly with regard to services, the conditions aren't too conducive to a real overheating. If you want to jump to the next slide. Of course, what are the implications of this really fast GDP growth, this really fast inflation at the moment? Well, growth expectations are picking up, inflation expectations are picking up. The corollary, the fallout of that means that interest rates have to rise. We've already seen the Bank of Canada start to signal that they're going to be dialing back the amount of their intervention. So coupled with less monetary support, rising inflation and growth, interest rates will pick up. Because of that, we anticipate a repeat of the cycle that played out, 5 years ago, where booming real estate market, 2017, interest rates started to push higher. The market immediately cooled down. So you can see, pretty much a mirror parallel image in this picture. We're not anticipating, a significant contraction in prices, mainly because the pace of interest rate increases is not too quick that it, completely stunts the economy's recovery. If you want to jump to the next slide. So, with all this real estate appreciation, it's really brought the question of affordability to the forefront. So what I did was, for a couple of key metro areas, take the median home price, assume no down payment. I'll explain that in a minute. And calculate, what's the monthly mortgage payment going to be on that home, and then divide it by the median family income in that metro area. So what you can see is that in Vancouver, shockingly high, the median monthly mortgage payment would account for 80% of the median family's income. Now, I said, of course, that doesn't include down payments, but I'm also not including other sort of home ownership costs, utilities, insurance, repairs, and all those things. So, roughly those things would cancel each other out. And so this is a fairly realistic picture. Of course, just because Vancouver is really high doesn't necessarily mean it's at risk. I mean, you can see it's been high for a really long time. Toronto has recently joined this club. But for the vast majority of Canada, most metro areas, the affordability measures are fairly safe territory. So despite this recent really strong run up in prices, because of the decline in interest rates, affordability hasn't changed too much. Of course, that does create an issue, thinking down the road, what's going to happen when people's mortgages start resetting at higher levels. So, the key component is, that incomes continue to grow. I think one of the questions, so why are we so, I think in terms of our outlook, why are we so much more focused on interest rates than the labor market? One of the reasons is, the old story, Canadians have relatively high debt loads. But, if you jump to the next slide, the reason I'm not too focused on the implications of further job growth for the housing market is you can see that if we break down the labor market by wage tiers, so number of employees who are in these different wage tiers, what we see is that where do we still need to recover? It's really in lower wage jobs. We can see that at the top of the range, in the high income category, employment has grown over 10%, which underscores why has the housing market been so strong? Well, because the typical high earning home buyer has been doing pretty well over the last year. So to the extent that we have more jobs to grow, and we're going to see some big jobs numbers through the remainder of this year. The issue is that a lot of that job growth is occurring amongst groups that wouldn't be the typical home buyer. So there's a limit to how much the remaining employment recovery is really going to benefit housing. And that's really why we're so focused on what's going on with interest rates. If you want to jump to the next slide. Sort of, the final thing I want to sort of end this discussion on is a topic that's getting a lot of attention, namely, remote work, telework, working from home. And, what we see here is prior to the pandemic, 76% of people never worked remotely. And only 6% of people were fully remote. At the peak of the pandemic, only 61% of people never worked remotely. So we had about a 15 percentage point increase in the number of people that at least worked a little bit remotely. During the pandemic, it was actually 14% of the labor market was completely remote. The key thing, though, is, looking ahead, StatsCan polled people and asked, do you expect to continue to be working from home? And going forward, about 65% of people said, I'm never going to work remotely or work from home. So that's why, for Canada, you see the light blue line, there's about a 10 percentage point increase in the number of people who previously never worked from home, but are now going to start working from home. However, the group of people that are going 100% remote, that's staying at 6%. So really the trend here is, a sizable group of people moving out of that never working from home category into this, working from home a little bit, but you can even see, the number of people who are going to be working from home, more than 50% of the time isn't even sort of half this change. So really a lot of, the shift in the labor market is people who are, maybe spending a, third or a quarter of their time working from home, which, to a large degree limits the distance from which they can live from their office. So, you can see here, clearly the really big change is in actually Ontario. And what really explains that, if you jump to the next slide, is the industry by industry breakdown of which workers are working from home and which ones aren't. We can see that those industries that dominate Ontario, finance, professional science and technical services, information and culture, which includes a lot of IT, software developer, things in that category, internet publishing. So there is a size of, I think sort of the bottom line story here is there is a sizable cohort of people who never work from home but are going to start working a little bit remotely. However, they're still going to be spending their majority of their time going to the office. So there's a limit to the extent that they can, how far they can live from the city. So what does this all mean for the implications for housing? Well, it bodes well for a strong outlook for single family, in the suburbs, but it makes us more pessimistic about the multifamily market in the urban cores. The only other last point I'll end with here is that of all the industries, what you see is a curious fact that real estate, many of our attendees today probably work in the real estate industry, declines in expectations of being able to work from home. So I guess the new industry mantra is hit the pavement, get out there, and that at least working from home in real estate is actually going to be declining over the next year. So with that, I'll pause and I'll hand it over to my colleague Brian.
Thanks, Brendan. Good afternoon, everyone. So we'll just jump right in and talk about what's happening in the market at the moment. Can you go to the next, please? So I'm not sure if everyone will see the slide flipping yet. Can we go to the next slide? Okay. Does everyone else see the slide, or am I just, is it just my system? Oh, I guess I can't ask that. Okay, awesome. So just to reorient everybody on what the slide just demonstrates. So this is our HPI as it represents since 2010. So it is quite a long run rate of just over 10 years. And what you're seeing here is the growth that we've experienced. And what I really want to bring focus on is the dark blue line and the light blue line, especially in the last few months, which I don't think is surprising to anyone. But the dark blue line is a national number focusing on our 13 major markets, and then the light blue line is actual representation of all of national. But what you're seeing is they're both increasing at a rapid rate, and if you're directly in the real estate market, you'll know that the last few months have been like the perfect storm, where it has been increasing quite rapidly. And we hear it in the media, we hear it in the news, and industry experts, and the data definitely supports those prices increasing in the last few months. Can we jump to the next? So let me just orient everyone around this slide, and then I'll actually talk to some of the key points. And so the small little graph that you see, that also you're not going to be able to read any numbers, but it just shows a demonstration of the trends of what the year-over-year growth has been over the last 15 years. So going back from 2006, how the market has changed and the growth in those trends over the past 15 years. And so we are experiencing a great moment in time right now where the national growth right now is sitting at 17.4%. But what is really different relative to historical times is if you look at the larger graph, is what's really driving that market. And the gap between single family detaches and condos has actually widened. It's actually at the widest point at any time in the last 15 years. And two, I think it makes sense, but it speaks to many reasons that we're seeing today, whether it's around the pandemic, the ability or the requirement to work from home, the desire for space, the space to have a home office in your home now. and the relative cost of space, right? The ability to now maybe expand your borders or where you're willing to move to or live in. And so we're really seeing single family detachers driving this marketplace at the moment. Now, I will comment though, condos is still positive at 3.3%. So it's not like it's falling, but the gap has significantly widened between the two property types. Next. Okay, so this slide, I'm going to take another moment as well, just to orient everybody what this represents. So we're highlighting the top 13 cities across Canada. The chart on your left is just a horizontal bar chart, but represents the year-over-year growth in those specific cities. We start off with the aggregate or the overall view, and then we break it down specifically. In the middle one is a single family detached, and on the right is the condos. And you'll notice the two charts on the left and the center are almost nearly identical, and which speaks to what we talked about before earlier, that single family detaches are driving the marketplace and driving the growth in the real estate industry at this point in time. The highlighted box that I highlight at the top, those 4 cities, I just wanted to quickly talk to. Ottawa is at the top, and as well, I think a little bit lower down on number 4 on the list is Montreal. And for many of you that are in real estate, you'll know that those two markets seem to be been on a storm basically for the last 5 or 6 months, which is massive volumes and demand that's happening in those markets. And so we're seeing the highest prices reflect that that perfect storm, if you will, in those two markets. And more recently in the media, what you're seeing in publications is around Hamilton and Halifax and the drastic increase in their year-over-year growth. And you're seeing those in those numbers and the pressures, I guess, that we may not normally associate with those markets as being hot markets. You know, when you compare it to the standards, Toronto's and Vancouver's, that it always seems to be in double-digit growth for many years now. Conversely, on the last chart, you'll see there's a mixed growth in terms of condos, where some are even still in Halifax and Hamilton are showing positive growth. Where we're still seeing pressure or actually declining value or growth is in some of our oil-based provinces, specifically in Calgary, Edmonton, Regina, and Saskatchewan. You'll see that at the bottom of the list. And even Toronto has been basically flat. So just wanted to highlight that as well. So in all in all, this chart just another level just to demonstrate that the importance or the value of space and then wanting to move out into single family detachers to get that additional space. What this chart shows is if you look across Canada at all the major provinces, each of the bubbles represent the size of the year-over-year growth. And I think we all get it, like all the charts show it. But what it doesn't demonstrate, and the table below is trying to express, is how much is proliferated across Canada. And so if we look at the city level, so there's roughly just under 1,000 cities. About a year ago, 75% of those cities were showing positive growth. So they're growing, you know, they're larger than zero. And if we take a 6-month view back to November, it was up to 83%. And now if you look at the most recent update at the end of May, almost 90% of cities are showing year-over-year growth. So that's a 12% difference, you know, if you consider about a year ago in terms of how many cities are showing positive growth. And that shows that it's not specific to one market, it's almost like every market is happening. You know, even if we drill down into the FSA level or the neighborhood level, there's just under 1,500 across Canada that we track. And, you know, again, if you look back at a year ago, 81% of those neighborhoods were showing positive year-over-year growth. And again, at the end of May, we're up to almost 90%. So that was also an 8% increase in the number of locations or neighborhoods that are experiencing positive year-over-year growth. So it's not, what we're trying to explain here is that it's not one specific market, it's literally almost every market is showing growth at this point in time. Next. So we're hearing in the marketplace that people are moving out of the cores, and there's many reasons why they're doing so. The ability to work from home, the removal or the requirement to work from the office or commute, more importantly. And so having a space to have an office is important. And families are recognizing that it is more important over this last year or so. And so you can take any market. Specifically, we just use Toronto in this example, but you can take pretty much anyone. And so in Toronto, on the left, you'll see that single family detaches have been growing about 14%, and condos, as I mentioned earlier, is roughly flat. And it doesn't matter which region of outside of Toronto, up to an hour or an hour and a half away, people are moving, and you can see the actual growth that are almost, if not double, of what Toronto's performing today. So if you are familiar with Ontario, you'll see London, Cambridge, Kitchener, Waterloo, they're well into the 20s, and with London hitting 30% year-over-year growth. If you're north of Toronto, you'll see also Newmarket out over 30%, but equally, almost all those cities north of us, when you consider Stouffville, Vaughan, Markham, they're all double digits. And then Durham region, it is phenomenal, their growth. They're all above almost 25%. And so you're seeing the pressures of those markets from people moving outside of Toronto. Next. So they flip to the next slide. What I did want to address is one of the questions is about, well, what does the future hold? And one piece that history has told us is that there is a boomerang effect. And what we see in the marketplace happening is, yes, while there's separation that's happening, we also recognize that things do bounce back, and they do come back to a general norm, if you will. And so I picked a different area. So I picked non-Toronto, just to give for a different example, but equally you could pick different examples. But here we're using Vancouver and Pitt Meadows. And Pitt Meadows, for some of you not familiar, it's also a bedroom community of Vancouver. It's just over an hour outside of Vancouver. And you can see the ebb and flow or the dance that happens between the growth of Vancouver as well as the growth of Pitt Meadows, and equally the decline of Vancouver and then the decline of Pitt Meadows. And typically you'll see that they lag about 3 to 6 months. They'll, as one rises, the other one will rise, and then again one falls, the other one will fall. And so what's that supposed to meant to give you comfort is that even though single families is taking a larger prominence in driving the growth in Canada, and condos is not, and equally certain markets, as we demonstrated in the previous slide, are driving certain growth, and Toronto's maybe doing well still, but maybe not, the condo market is still kind of relatively flat. But what's this all to say is that we do anticipate that it will bounce back, and it will continue to do this common dance that we normally see. The exact timing, I think that's still, I'll leave it to smarter people than myself to help us estimate those things. But obviously the factors that are that Brendan did allude to was about the vaccinations, and whether that return to normal will play an implication in that. So this last slide, I just want to wrap it up, is what does this all mean, and what are the challenges that we're seeing in the marketplace? And so a couple of 4 key points I just wanted to leave you off with that that's happening in the business or in the industry that are impacting consumers most importantly, but even appraisers and lenders. And so as I talked about the year-over-year growth that's driving across Canada in every city and almost every FSA or neighborhood, demand is great, right? So there's a lot of activity happening in terms of what we're seeing, but that also puts pressure on the supply chain of appraisers, right? There is a fixed number of appraisers that we're still working with and partnering with, and it is saturated from that perspective, which then drives out to turnaround times. Admittedly, some of you will have received longer than turnaround times than you'd probably normally expect. But we do expect that to eventually dampen. It just feels like these last 5 or 6 months has been forever a spring market. Pandemic. And so with stay-at-home orders, a lot of us have moved or migrated to modified full appraisals where we rely on the homeowners to provide some interior photos and shots. And so while we may think it's easier, in many ways it actually has made it more complicated. And so the best analogy I can say would be is, for many of you, I'm not sure about you, but helping your parents with their TV or helping them with their computers or their internet. When there's a problem and you have to resolve it, it's quite easy to be in the moment and actually touch the computer or the TV and fix the issue and understand what's happening. And that's what I say with the full appraisals. When they're on site, they're very easily be able to walk the premise, they'll be able to understand what's happening and make the assessment very quickly. Conversely, doing it over the phone and trying to walk through the homeowner and understand what's happening with pictures, it does create a little bit more complications in the process, but it is a very different type of process. And so everyone's trying to work through that new process, and obviously there are some challenges, but everyone's doing their best to resolve them. The last couple items I just want to talk about are the price growth changes. They are happening very rapidly. We are hearing about multiple bids, the rapid prices, and the challenges of trying to get the proper comparables and assessments with these last few months. And so that does create new complications. And the last one is consumer expectations. Everyone's hearing about real estate on the industry in the publications, talking to friends, families, what have you. And the fear of missing out is becoming readily real and apparent. And so that does put more consumers in the market looking and considering, especially after this long duration of the pandemic, where maybe they've put off that home purchase. So that does change a little bit of the dynamic, but it is something that I think all of us can understand and relate to. So those are kind of the 4 key challenges that I just wanted to highlight in terms of just wrapping up. And I'll pass it off to Abhilasha, who will help walk us through the forecasts.
Thank you, Brian. Can you hear me? Okay, great, thank you. So I'm going to start my talk with trends in the new home market, and then talk about our house price forecast model, and then move on to our short-term and long-term house price forecast. Next slide. Next slide, please. Maybe I'll start talking and then the slide will come up. So the slide which is going to come up shows the single family permits and the multifamily permits and how they have been doing in the last decade. And the key takeaway from this chart is that the housing market today is hot. It's hot relative to history, and it's hot relative to other markets. Builders have been rushing in to meet demand, particularly in the single family market, as we are in a situation of elevated demand, which is meeting limited supply. So far, the trends that we have seen in house prices that Brian talked about in sales, construction, it is clearly evident that the pandemic did not follow the normal script of a recession for a housing market. That is, consumers usually pull back during recession and as they are worried about their job market. So what was different this time that the consumers behave differently? Number one would be interest rate, which came down immediately, coinciding with the pandemic, which increased the purchasing power of the buyers. And then the number 2 point would be the asymmetry in the job market, which Brendan talked about earlier. Number three would be physical stimulus, which shored up consumer balance sheets. And last but not the least, the pandemic itself, which shifted consumer preferences over the last few years. That is, they moved from condo apartments to looking for more of larger detached homes outside the city. And that's not what the builders were building over the last decade. You can see in this chart is that single family permits were falling, kind of trending down, while the condos were trending up. So what happened because of this was construction was more skewed towards condo sector, and that was mainly because of strong population growth driven by immigrants, and also because of limited space. And although there is more demand for single family units right now, but multifamily permits have also increased during the permits. And there could be several reasons. One of them could be that usually multifamily permits require a longer time and investment in terms of planning ahead, that they need to go build a multifamily unit. So the builders were already in process, and it was hard for them to back off from what they had already started working on. And secondly, in the long term, we do expect that once herd immunity is achieved, students will return back, immigrants will come back to Canada, and there would be strong population growth, and the demand for condos will pick up again. Next slide, please. So I'll start talking. Oh, it's already there. Thank you. So elevated demand is not only pushing prices in the existing home market, it's also pushing prices in the new home market. Input prices of materials such as lumber, gypsum, steel, all of them have gone up. In fact, in case of lumber, what you see in this chart have almost doubled in the last 1 year. And that's mainly because of higher demand for these materials, and the supply side issues will resolve over time, but then it will take some time for these issues to resolve. So prices will remain elevated for some time. And can you move to the next slide, please? So now I'll switch gears and talk about our house price forecast model. Canada's house price forecast is generated by our global macroeconomic model, which produces around 13,000 economic variables, and it spans across 73 countries. Our global model is a structural model consisting of various simultaneous equations. And as far as the forecasting Canada's house price goes, we follow a two-step error correction approach, which relies on long-term economic variables such as income, population, and it also relies on short-term economic variables, cyclical economic variables such as mortgage rates, such as unemployment rates. And we follow the same approach when it comes to forecasting our house prices for all levels of geographies, be it national, subnational, provinces, submetros. We follow the same approach for all the levels of geographies. Next slide, please. So we use our framework not only to come up with our baseline forecast, but we also use that to produce 11 more alternative scenarios for each country that we forecast. And this is just the list of all the scenarios that we produce. Next slide, please. And waiting for the next slide. So before I go ahead and talk about the forecast, there's one last slide which I want to show, which is the data from OECD, and it's data about household debt, out of which mortgage is the biggest component. And it shows household debt as a percentage of net disposable income. And if we compare Canada among other developed countries, it's among the top of the list. And what happens because of this is that it makes Canadians more sensitive compared to other countries when it comes to interest rate changes. And historically, this was evident during the previous housing boom that we saw during 2016 and 17. So here in this chart, you can see that Canada is well ahead of Germany, Spain, Belgium, France, Ireland. And these are all developed countries. Next slide, please. So in this chart, you can see that during 2016-17, the house prices were rising rapidly. And then during 2017, mortgage rates started to rise. It was not only mortgage rates, but tougher mortgage rules, which slowed household borrowing. So because of that, demand slowed, and the housing supply is kind of fixed in the short run. It's inelastic. So house prices came to a standstill, almost close to zero in terms of year-ago changes. And we expect similar events to play out in late 2021 and 22. When mortgage rates start to rise, we expect that house prices will slow down. There's another reason why we expect house prices to slow down is because of the tightened mortgage stress test, which the Office of Superintendent Financial Institutions just announced recently that they are going to increase the qualifying rate for uninsured mortgages. So this will reduce demand for single family units and kind of address the growing concerns of affordability or rising debt burdens for the Canadians. Next slide, please. Okay, so that was our national house price forecast that we do expect prices to slow down, but the extent of slowdown would vary considerably across different areas. It would depend upon a lot of factors. For example, what is the affordability of an area? For example, Toronto, Vancouver are among areas which have the least affordability. They are the most less affordable places. So we will see a greater impact on these areas. And another factor which would determine our house price forecast is how overvalued or undervalued our current house price is in a region. So this chart over here shows the deviation of our current house price from a trend house price. So if you recall, I mentioned earlier that we forecast our house prices using a two-step process. So in the first step, we calculate the trend house price, which is based on long-run factors such as population and income. And based on that trend price, we calculate the deviation of what is the deviation. So higher the deviation, more it is overvalued or undervalued. And it should not be a surprise to anybody that Toronto, Hamilton, Vancouver are one of the most overvalued metro areas. On the other hand, Calgary and Edmonton are the most undervalued metro areas. In fact, the smaller metro areas like Hamilton are more overvalued just because of the recent price growth that we have seen in these areas. Even single-family homes in Montreal they were reasonably valued, but now they have become overvalued just because of the recent growth in prices compared to the median income in those regions. So now what this overvaluation or undervaluation means in terms of our forecast in the coming months or coming year is that there would be can you go back to the previous slide, please? So what it means in terms of overvaluation, what the overvaluation or undervaluation means is that the metro areas where house prices are overvalued, there would be a general downward pull on house prices over the coming years. The metro areas in the prairies and to some extent some metro areas in the Atlantic will see an upward pull in house prices just because those areas have been undervalued. However, we should keep in mind that overvaluation or undervaluation does not guarantee that the prices would fall immediately. All it means is that there would be a general pull for them to come towards trend house prices in the long run. Next slide, please. I think there's a slide missing out here, but we expect that slowdown in prices will be more in case of Toronto, Vancouver, and Montreal. But Montreal would see a higher degree of slowdown compared to Toronto and Vancouver. One reason would be because it has slower immigration in the forecast, and also it has much less wealth inflows compared to Toronto and Vancouver. On the other hand, we expect that the prices in Calgary and Edmonton will continue their upward trend just because they are highly undervalued. And now coming back to, next slide, please, and coming back to the national forecast, we expect that the prices would continue to rise in the short run, that is in the late 2021, but it will gradually slow, and it will slow considerably in the first half of 2022. However, we do expect that the pace of price appreciation would increase in 2023 as because of higher immigration once herd immunity is achieved or when the market is completely healed. However, I still don't see the next slide, but the path and the timing of the labor market could be, I'm sorry. The path, the timing could change if the labor market recovery is faster or slower. For example, in the alternative scenario, which is the 90th percentile, it would be a case where herd immunity is achieved later. There could be, or there's a fourth wave, so there could be travel restrictions, there could be limit on gatherings, there could be business closures. And because of all these loan delinquencies, defaults could escalate quickly, and it could lead to excess supply in the market, putting downward pressure on house prices. Similarly, on the upside, if herd immunity is achieved earlier than expected, and along with improved consumer confidence, faster employment growth and income growth, house prices could accelerate at a much faster pace. That's it from my side. Thank you.
Thank you, Abhilasha. We did receive some questions in advance, which we tried to incorporate into our presentation. I realize that we're getting tight for time at this point and want to be respectful of everybody's schedule. So if your question didn't get answered or you have a question, I'd like to suggest you reach out to us directly and we'd be more than happy to get back to you. I'd really like to give a big thank you to our three speakers for their very interesting insights and sharing of your knowledge. And a thank you to our audience for joining us and participating in this session today. As we mentioned, the webinar will be recorded and the deck sent out shortly. And with that email, we'll also provide you with a quick survey so we can get your feedback on what you liked about the session and where we can improve. Also, please feel free to contact RPS or the Moody's Analytics team if there's anything that we can help you with. We hope your families and colleagues stay safe, healthy, and enjoy the fantastic summer weather that's finally here. Thank you very much for your time, everyone. I look forward to speaking to you all soon.